But let's turn our attention to the oil and gas space. Well, India has signed a one-year deal to source liquefied petroleum gas from the United States. 10% of annual LPG imports in 2026 will be from the United States. To analyze this as well as the CNG supply disruption in Mumbai, we're now joined by Nilesh Ghuge, the analyst institutional equities at HDFC Securities. Hi Nilesh, good morning. Good to see you win. Let's talk about the LPG piece first with regard to the deal that India signed with the United States. What is your initial comments on it and who stands to gain?
Yeah, definitely it's a positive move for, I will say, overall Indian LPG market. It not only gives the stability, but resilience, and it's integrated the entire LPG ecosystem globally. So that's a definitely positive move from the government and the PSU oil marketing companies.
Okay, all right. What do you make of this, supply disruption here in Mumbai? MGL, we just had the management who joined us. They were saying things will get resolved. Your view on it, what are you penciling in terms of volumes? Will you have to, scale it back a little bit? Your take?
Yeah, see, our back of envelope calculation indicates that if supply had been stopped for, let's say, a couple of weeks, then it could be the impact of roughly about 3.5 to 3.8% at top line level. But they restored the supply in just less than a week or maybe just a couple of days, 2 to 3 days. So not much impact on the revenue, just for a couple of days, that's all. And that too restrict to the CNG because they continue supplying this domestic PNG supply.
Right. Got that. Nilesh, do you have a coverage on oil marketing companies?
Yes, sir. Yes.
Okay. And of course, Reliance as well, right?
Yeah.
My question is, we are in an environment where it's been actually various shades of it since COVID, that refining capacity has been, they've been, for whatever reasons, has been running, I guess, a little behind. And hence, especially on diesel, etc., cracks are pretty healthy, pretty strong.
Yes.
Is that something you've looked at closely? Standalone refiners have done absolutely fantastically well. Chennai Petroleum has doubled from its March levels this year. MRPL has done phenomenally well. The more diversified IOC, HP, BP, have done well, but not as well. There's a marketing component as well. First of all, what's your view? Will these high spreads cracks persist? And what's the best way to play them from here?
Yeah, you're right. The pure refiners like MRPL, CPCL in this environment will continue to do good. These cracks, fuel oil cracks are still better. So they will continue to perform better in, let's say, this quarter as well. So MRPL, CPCL, which are pure refiners. As far as oil marketing, where they are losing on some marketing margin because the cracks have moved up while the retail prices are there is no change in retail outlet prices. So they are losing on the marketing side. At the same time, they are getting on the refining side. But overall, if you let's look at from net perspective, there is not much gain for the oil marketing companies in this environment. This positive thing is the crude oil. The crude oil prices are remaining in the range of $62 to $64 per barrel. If I compare that with the last year, it was around $85. So that's the comfort that oil marketing companies are doing. Also on this LPG front, till 2Q, there was under recovery of close to about 100 rupees. And now in Q3, the under recoveries have come off to about 40 to 50 rupees per cylinder. So that's a positive sign for oil marketing companies. At the same time, government has announced that 30,000 under recovery for last year will be paid to oil marketing companies over next 12 months, starting this month. So this will strengthen their balance sheet as well. The working capital condition will be good for oil marketing companies.
And on the standalone refiners, you think there's more to go? Because there are various arguments. JRM's moving up, the replacement cost as well is quite high in comparison to what they're trading at, and their balance sheets are pretty okay. Do you think there's more scope?
See, but cracks are still in the healthy position, I will say. So their earnings this quarter also will be very good. So still, I mean 1.5 month is left, but still till today, the margins are much better compared to last quarter, compared to last year. So there is still some steam left in this MRPL CPCL.
That the market already knows. The point is, stocks will try to price where things will be 6 months down the line. Is there any way to tell?
See, overall, in my belief, the long run, these cracks may not sustain at this such a high level. If you take the view of, let's say, 1.5 year down the line, there will be some pressure on particularly diesel cracks and gasoline cracks. But momentum is in their favor as of now.
Okay, all right, Nilesh, we'll leave it there. Good speaking with you. Thank you very much for joining us, and good to get that perspective.